Taxes play an important role in every real estate transaction, and understanding which taxes are due at closing helps buyers and sellers prepare for the financial responsibilities that accompany transfer of ownership. In previous sections, you learned how prorations ensure that each party pays its fair share of yearly expenses. This section builds on that foundation by explaining the specific taxes triggered by a real estate closing, how they appear on the closing statement, and how Arizona property taxes are handled. Taxes at closing generally fall into three categories. First are taxes imposed on the transfer of ownership itself, such as state deed transfer taxes. Second are taxes associated with the buyer's mortgage, such as documentary stamp taxes and intangible taxes in certain states. Third are property taxes owed to the county, especially important in Arizona, where property taxes are billed semi-annually and paid in arrears. A well-prepared real estate professional must be familiar with all three to help clients understand why certain charges appear on the settlement statement and who is responsible for paying them. State taxes on the deed. Most states impose a transfer tax when real estate is conveyed. This tax is generally collected at the time the deed is recorded. The most common form is documentary stamps, which must be affixed to the deed before the recorder will accept it. Although Arizona does not currently impose a state deed transfer tax, it is still essential to understand the concept because many national exam questions and other states rely on this system. Transfer taxes may be calculated as a percentage of the selling price or as a dollar amount per $100 of consideration. When using a per $100 calculation, the total sales price is divided by 100. If the result is not a whole number, it must be rounded up to the next whole number. This ensures every fraction of $100 is taxed. For example, if a property sells for $115,730 and the tax rate is 55 cents per $100, you divide the sales price by 100 to get 1,157.30. Because the number is not whole, you round up to 1,158 and then multiply by 55 cents for a total tax of $636.90. On the closing statement, this tax usually appears as a debit to the seller, although state law or contract negotiation can shift the cost to the buyer. State taxes on the mortgage. Many states also impose a tax on instruments that contain a promise to pay money, such as mortgages, notes, or contracts for deed. These taxes are also commonly collected through documentary stamps purchased from the recording agency. In some states, an additional intangible tax applies to the mortgage amount. These taxes are normally paid by the buyer or borrower because they relate directly to the buyer's financing. Even in states without mortgage taxes, lenders often charge recording fees that must be paid at closing. Regardless of where you practice, it is important to know how mortgage-related taxes affect the buyer's total cash-to-close figure. Buyers frequently ask why mortgage taxes or recording fees apply to them, but not the seller, and an agent must be able to explain the reasoning clearly. Arizona property taxes. Unlike many states, Arizona does not charge a state transfer tax on real estate sales. However, Arizona property taxes are critical because they are paid twice a year and always in arrears. This means taxes are paid after the period has passed, not before. The first half of the year's taxes is due on October 1st of the same year and becomes delinquent in November. The second half is due on March 1st of the following year and becomes delinquent in May. County assessors value each parcel, but property taxes are paid to the county treasurer. Every fall, the county mails tax bills that include 2 detachable coupons, one for each half of the year. When a property has a mortgage, the lender typically receives the tax bill because most impounds are handled through escrow accounts. At closing, taxes must be prorated to ensure the seller pays for the period they owned the property and the buyer pays for the remainder. If the closing occurs after tax bill information becomes available, escrow typically pays the first half or full year of taxes and then prorates charges between buyer and seller on the settlement statement. Proration ensures each party pays only for the days they owned the property. Who pays the real estate taxes the year you buy your home? When buying a home, the seller should pay taxes up to the day of closing, and the buyer pays the taxes from that day forward. If the seller already paid the entire year's taxes, the buyer reimburses the seller for the buyer's share. If no taxes have been paid yet, the seller is charged their portion, and the funds may be placed in escrow to ensure payment. Consider an example. Suppose a home closes on September 1st. The tax year is the calendar year, and the total annual tax is $900. The seller paid this amount in full on August 1st. The buyer now owns the home for 122 days of the year. The buyer should reimburse the seller for their share of the prepaid taxes, $300. Interestingly, federal tax law imposes a different rule. The IRS treats the seller as having paid taxes up to the date of sale, and the buyer as having paid taxes from the date of sale, even if one party never actually reimbursed the other. This means the proper prorations should be included in the contract to ensure fairness and avoid confusion when filing tax returns. Review summary. This section explains how taxes due at closing are handled, including state transfer taxes, mortgage-related taxes, and property taxes. Transfer taxes apply in many states and are commonly paid using documentary stamps attached to the deed. Mortgage taxes, when imposed, are usually paid by the buyer. Arizona property taxes follow a unique schedule, paid twice per year, always in arrears, and must be prorated fairly at closing. Proper proration ensures each party pays taxes only for the time they owned the property, and tax deductions follow IRS rules, regardless of who physically pays the bill. Understanding these systems strengthens your ability to guide clients through the financial realities of closing and prevents surprises on the settlement statement. Discussion. Why are transfer taxes usually shown as a seller debit on the closing statement? Answer. Because transfer taxes are tied to the conveyance of ownership, and the seller is typically responsible for delivering a marketable deed, making the tax a seller obligation unless negotiated otherwise. Why does Arizona prorate property taxes at closing? Answer. Because taxes are paid in arrears, meaning sellers owe taxes for the period they owned the property, even if the bill has not yet come due. How does the IRS treat property tax deductions for buyers and sellers? Answer. The IRS automatically assigns deductions based on days of ownership, even if one party did not physically pay its prorated share. Why is it important for the contract to specify prorations clearly? Answer. Clear contract terms prevent financial disputes, ensure fairness, and avoid confusion when taxes are filed or when settlement statements are prepared. Closing remarks. Taxes at closing illustrate how financial details intertwine with legal responsibilities in real estate. When you understand how transfer taxes, mortgage taxes, and property tax prorations work, you can guide clients confidently and prevent misunderstandings. This knowledge protects your clients and elevates your professionalism during one of the most financially significant events of their lives.